All right, tomorrow's the big day, but we've got one more session ahead of it. Still seems appropriate to warn caution about confusing the political cycle and the election with a catalyst. Firstly, where we're at on the risk radar: stocks yellow, bonds red. The green light dropped off equities last week, given the breakdown, the lack of technical support around big tech earnings, and the fact that it seems bonds were creating a bit of an issue again, with treasuries getting shredded last week, even while stocks were down. That's telling us that 60-40 might be stressed. Now, the Fed takes second place, of course, to the election tomorrow. But a few of these themes do have some real policy ties. But it's important to really kind of distinguish and set apart the myth and narrative versus what logically makes the most sense. For example, and by the way, anything that you want to try and tie into policy still needs to have some price action behind it. Price is king. So for example, think about crypto, the green light there because of Bitcoin's breakout from the downtrend. However, there are technical issues still ahead that make this, I think, a place that you do want to watch for potential election volatility. The RSI in the latest run-up to the fresh record was again declining compared to the previous run-up to this 60 to 70 range. And so you have this bearish divergence that still is a technical threat. However, we also know that policy-wise, there is a pretty hard skew in terms of how crypto is being talked about. Left versus right, Trump versus Harris, the notion of getting rid of Gary Gensler being a Trump idea, and looking at the regulatory side that has been somewhat aggressive. So in this sense, especially also because Bitcoin does well when people talk about it. When you've got one person who says they're going to talk about it more, to me, there's a decent logic there because it's a sort of purely speculative asset in my mind. But that's why Bitcoin also is a pretty clear way to try and get a read on this, arguably, whereas some of the other stuff is just nonsensical. One that's really bothered me, of course, is the connection between bonds and the election. Be very, very wary about this one. The low for the yield was put in that the day the Fed cut 50. And the logic, as I argue here, is very straightforward for why yields would go up. The economy is in decent shape. Numbers are beating expectations. You start cutting rates, it's going to raise the possibility of an acceleration in the economy. So even though today bonds are rallying and yields are down, some people are trying to argue that around the election stuff. I'd be very, very cautious about that. If you think that a single 4 years of any one person is going to control the bond market, same story with stocks. Stocks generally go up over time, and generally the bond market is going to reflect the underlying economic potential, which is not going to change overnight. Now, the Fed behind the election possibly could be a little bit of a catalyst in here because maybe if Powell's been watching the yield curve go up like this, he doesn't feel the need to do 25, but the market says he's going to do 25. That being said, you should probably assume yields continue to grind higher because there's no evidence to the contrary. So we have to try and separate these things out. To be continued, we've got one more day of analysis on this stuff.